Some called him the Dean of Wall Street. Others called him the father of value investing. But to those who truly studied his work, Benjamin Graham was much more than a financial genius. He was a philosopher of money, a teacher of discipline, and a believer in the power of rational thought in a world ruled by fear and greed. Today, we're going to tell the full story of Benjamin Graham, the man who turned market chaos into a science, mentored Warren Buffett, and left behind an investment philosophy that still guides millions around the globe. Benjamin Graham was born Benjamin Grosbaum on May 9, 1894, in London, England, to Jewish parents. His family moved to the United States when he was just a year old, settling in New York City. At first, life seemed promising. His father ran a successful business importing fine china. But when Benjamin was 9, tragedy struck. His father died, leaving the family in financial ruin. The boy who once lived in a comfortable home now understood poverty firsthand. His mother took in boarders to make ends meet, and Graham began to see money not just as a means of living, but as something fragile, something that could vanish overnight. These early struggles left a deep impression. They didn't just motivate Graham to succeed, they gave him the empathy and realism that would later define his investment philosophy. Despite financial hardship, Graham excelled in school. He won a scholarship to Columbia University, where he studied mathematics, philosophy, and languages. By the time he graduated in 1914, he had offers from multiple departments to stay as a professor. But Graham had other ambitions. He wanted to test his intellect in the real world. So, at just 20 years old, he turned down academia and took an entry-level job on Wall Street. His starting salary was $12 a week. It was 1914, the dawn of a new financial era in America. At Neuberger, Henderson and Loeb, Graham quickly distinguished himself. His ability to analyze companies was exceptional. He could read a balance sheet like a novel, spotting hidden strengths and dangers others overlooked. Within a few years, he was making $600 a week, a huge sum for the time. But Graham's real education was just beginning. The 1920s were a time of wild speculation. Stocks soared without reason, fortunes were made overnight, and greed was the air people breathed. Graham participated in this exuberance, sometimes trading with little more than gut feeling. But as we'll see, the market had a brutal lesson in store. October 1929, the stock market collapsed, wiping out billions in wealth. Graham's portfolio was devastated. Years of work evaporated in days. This was his turning point. He realized the market wasn't a casino, it was a weighing machine, as he would later describe. In the short term, stock prices could be driven by fear, rumors, and speculation. But in the long run, they reflected the true value of a business. From the ashes of the Great Depression, Graham began to build a systematic approach to investing, one that relied on logic, evidence, and discipline rather than emotion. Through the 1930s, Graham developed what would become known as value investing. His principle was simple but revolutionary. Buy a stock only when it sells for less than its intrinsic value. Intrinsic value was the true worth of a company, based on its earnings, assets, and future prospects, not on market hype. He looked for what he called a margin of safety, buying at such a discount that even if things went wrong, the loss would be minimal. This idea would become the cornerstone of modern investing. In 1934, Graham and his colleague David Dodd published Security Analysis, a massive book that laid out the rules of value investing. It became the Bible for serious investors. Then, in 1949, he distilled his ideas into The Intelligent Investor, a book Warren Buffett later called by far the best book on investing ever written. One of Graham's students at Columbia in the 1950s was a young man from Omaha named Warren Buffett. Buffett was so impressed with Graham's lectures that he offered to work for him for free. Graham declined the free labor, but eventually hired Buffett at his investment partnership. Buffett absorbed Graham's methods, but added his own twist, focusing more on the quality of businesses. Still, Buffett always credited Graham as his greatest teacher, saying, "Ben Graham taught me how to think about investing in a way that made sense for the rest of my life." Graham's strategy involved analyzing financial statements carefully, understanding earnings, assets, and liability abilities, buying below intrinsic value, finding undervalued stocks, demanding a margin of safety, avoiding large losses, diversifying, spreading risk across multiple investments, avoiding speculation, never chasing trends or fads. One famous example was his investment in the Northern Pipeline Company. The market valued it cheaply, but Graham discovered it held assets worth far more than its stock price. He bought heavily, and when the true value emerged, he made a significant profit. Graham retired from active investing in the 1950s, splitting his time between California and France. He enjoyed art, literature, and teaching. Though he could have remained a billionaire, he preferred a simple life, giving away much of his wealth. When he died in 1976, Graham left more than a body of work, he left a mindset. His teachings formed the foundation of modern investment theory, influencing not just Buffett, but countless others. Even a century after he began, Graham's rules still work. In a world of meme stocks, cryptomanias, and market bubbles, his message is timeless. Invest with discipline. Ignore market noise. Focus on value, not price. Always demand a margin of safety. Benjamin Graham didn't just teach us how to invest, he taught us how to think. In a world where greed and fear still rule, his wisdom remains a compass for those seeking not just wealth, but financial peace of mind. Subscribe to Little English Studio for more stories of extraordinary lives. Like, share, and comment to keep the wisdom alive.